The screen flickers. A single number appears, 73.2. It blinks twice, then nothing. Somewhere in a building with no windows, someone realizes the system hasn't updated in 4 minutes. 4 minutes shouldn't matter. The room stays quiet. Another screen shows the same number, 73.2, still frozen. A hand reaches for a phone. The call doesn't go through immediately. When it does, the voice on the other end says only, "We're seeing it too." In this simulation, the mechanism that prices the dollar against other currencies stops reflecting new information at 9:14 a.m. Eastern Time on a Tuesday in October. No announcement is made. The freeze isn't dramatic, it's absence. Trading algorithms notice first, they're built to react to movement, and movement has stopped. Within 90 seconds, automated systems begin pulling orders. Not because they're programmed to panic, but because they're programmed to withdraw when they can't calculate risk. The withdrawal is silent. Numbers disappear from screens. Depth vanishes from order books. By 9:16 a.m. human, traders are staring at something they've never seen. A market that is not moving because there's nothing left to move. We assume this moment was caused by a technical failure in the settlement system that connects major central banks, though the specific mechanism doesn't matter as much as what happens next. The Federal Reserve issues a statement at 9:22 a.m. It's 3 sentences. It says technical difficulties are being addressed. It says the dollar remains fully backed. It says normal operations will resume shortly. The statement is accurate and useless. Markets don't trade on statements when the infrastructure isn't working. In London, it's 2:22 p.m. The pound is still trading against the euro, against the yen, against everything except the dollar. This creates a problem. Most international contracts are priced in dollars. If the dollar can't be priced, the contracts can't be valued. A shipping company in Singapore has a payment due in 6 hours. The payment is in dollars. The company's revenue is in 7 different currencies. Under normal conditions, the company hedges this exposure every morning. This morning, hedging is impossible. The treasurer makes a decision, hold the payment. It's the only decision that makes sense. Across 11 time zones, thousands of similar decisions are being made in quiet offices by people whose names won't appear in any report. But this wasn't the real problem. The real problem was that the dollar isn't just a currency, it's the collateral underneath almost everything. U.S. Treasury bonds are used as margin for derivatives contracts worth more than $600 trillion in notional value. When the dollar's price freezes, the value of that collateral becomes uncertain, not worthless, uncertain. And in a system built on leverage, uncertainty is functionally the same as loss. Margin calls start at 10:03 a.m. They're automatic. The system doesn't wait for humans to decide. A pension fund in Amsterdam receives a notification. Deposit $1.2 billion in collateral by end of day, or positions will be liquidated. The fund manager looks at the screen. The dollar market is still frozen. He can't buy dollars. He can't prove what dollars are worth. He can't meet the call. The system doesn't care about his situation. At 4:00 p.m. London time, positions begin unwinding. The unwinding is procedural. Contracts are closed. Assets are sold. The sales happen in whatever markets are still functioning. European equity markets are still open. They drop 4% in 18 minutes, not because of news, because of forced selling by institutions that need to raise cash in any market that will take it. In New York, it's 11:00 a.m. The stock market is open. It's moving, but differently. Volumes are thin. Prices are erratic. Every few minutes, a stock will jump or fall by amounts that would normally take hours. These aren't driven by information. They're driven by the absence of liquidity. The Treasury Department convenes a call at 11:30 a.m. Participants include the Federal Reserve, the Securities and Exchange Commission, the Commodity Futures Trading Commission, and representatives from the largest banks. The call lasts 14 minutes. No decisions are announced afterward. That silence tells the professionals everything they need to know. There is no immediate fix. By 1:00 p.m. Eastern, the freeze has lasted nearly 4 hours. In Hong Kong, it's 1:00 a.m. Wednesday. Markets there will open in 8 hours. The Hong Kong Monetary Authority faces a choice. The Hong Kong dollar is pegged to the U.S. dollar. Maintaining that peg requires being able to trade U.S. dollars. If U.S. dollars can't be traded, the peg can't be maintained. The authority announces that markets will open on a delayed schedule, pending clarification of external conditions. It's the first government admission that this isn't just a technical glitch. In Tokyo, planners are watching. The yen is moving against the euro, against the pound, but the dollar-yen pair is frozen. Japan holds more than $1 trillion in U.S. Treasury securities. If those securities can't be priced, Japan's foreign reserves can't be valued. The Ministry of Finance releases no statement. Silence, in this context, is its own form of communication. Something else was starting beneath the surface. Corporate treasury departments operate on a simple assumption. They can access dollars when needed. Credit lines exist. Commercial paper markets function. Overnight funding is available. These assumptions are built into every cash flow model, every payroll system, every supply chain payment. On Tuesday afternoon, a manufacturer in Ohio needs to pay a supplier in Mexico. The payment is routine, made every 2 weeks for 6 years. The payment is in dollars. The manufacturer's bank executes the transaction, but the confirmation doesn't arrive. The system shows the payment as pending. Pending isn't normal. The Treasury manager calls the bank. The bank says, international payment systems are experiencing delays. The word delays is doing heavy work. What's actually happening is that correspondent banks, the institutions that move money between countries, have quietly stopped processing dollar transactions until they can confirm what a dollar is worth. The payment sits in digital limbo. The supplier in Mexico doesn't receive it. The supplier has his own payments due. Those payments also don't go through. By 4 p.m. Eastern, the freeze has lasted nearly 7 hours. U.S. markets close. The Dow is down 6.8%. The S&P 500 is down 7.1%. Treasury bonds, the safest asset in the world, haven't traded all day. Their last price is from Monday. That price is now meaningless. Mutual funds that hold Treasury bonds are required to publish a net asset value every day. They can't. The value depends on being able to price the bonds. Several large funds suspend redemptions. This is legal. It's also terrifying. Investors who want their money back are told to wait. No timeline is given. In living rooms and office break rooms, people start checking their brokerage accounts. The numbers are there, but they feel different now. Are those numbers real if they can't be turned into cash? Overseas, Wednesday morning arrives. Asian markets face an impossible situation. They can't open normally because half their reference prices are missing. Singapore announces a one-day trading halt. South Korea follows. Australia tries to open, but suspends trading after 12 minutes when circuit breakers trigger. The Australian dollar, normally stable, moves 8% in 6 minutes. Not because of Australian news, because traders are trying to get out of anything connected to the frozen dollar system. In Beijing, the People's Bank of China says nothing publicly. Privately, officials are calculating. China holds over $800 billion in U.S. Treasury securities. If those can't be sold, can't be priced, can't be used, they're not reserves. They're decorative. The yuan is allowed to drift lower against the euro. It's a small move, barely 2%, but the direction matters. It's the first sign that China might be preparing for a world where dollar stability can't be assumed. Wednesday morning in New York, day 2. The dollar markets are still frozen. Engineers have been working through the night. The problem isn't software. The problem is that the settlement system depends on synchronized inputs from multiple central banks, and one of those inputs is corrupted in a way that can't be isolated without shutting down the entire network. Shutting down the network means shutting down the infrastructure that processes $4 trillion in transactions every day. The decision is made to attempt a manual workaround. It will take time. No estimate is given. Markets open Wednesday under emergency protocols. Stocks can trade, but with expanded circuit breakers and position limits. Treasury bonds remain frozen. Money market funds, which hold short-term Treasury debt, are stuck. They can't sell their holdings. They can't meet redemptions. The Securities and Exchange Commission issues an order allowing funds to suspend withdrawals for up to 10 business days. The order is described as precautionary. It's actually essential. Without it, the funds would collapse. What happened next wasn't immediate, but it was inevitable. Companies that operate across borders need to pay employees, pay suppliers, pay rent in dozens of countries. Those payments require currency exchange. Currency exchange requires a functioning market. By Wednesday afternoon, payroll departments are discovering that international wire transfers are being rejected or frozen mid-process. A tech company in California has 3,000 employees in India. Payroll is due Friday. The payment has to be converted from dollars to rupees. The conversion can't happen. The company's bank suggests paying in rupees directly from rupee reserves. The company doesn't have rupee reserves. It has dollars that can't be converted. The HR department sends a memo. Payroll may be delayed. The memo is careful. It doesn't explain why. In Bangalore, 3,000 employees read the memo and start asking questions. In Europe, it's Wednesday evening. The European Central Bank holds an emergency session. The question on the table is whether to extend emergency lending to European banks that are facing dollar funding shortages. Many European banks borrow dollars short-term to finance long-term dollar assets. When the short-term borrowing markets freeze, those banks can't roll over their funding. They need dollars immediately. The ECB doesn't have dollars. It has euros. It can swap euros for dollars with the Federal Reserve through standing swap lines. But those swap lines depend on the same settlement infrastructure that's currently frozen. The ECB announces it will provide euro liquidity to any bank that needs it. This helps, but it doesn't solve the dollar problem. A bank that owes dollars can't pay that debt with euros unless someone is willing to take euros in exchange. And right now, no one is. Day 3, Thursday. The freeze is entering its third day. News coverage has shifted from technical explanations to human stories. A retired couple in Florida tries to withdraw money from their money market account to pay for a medical procedure. The withdrawal is denied. The fund is frozen. They call their advisor. The advisor has no information. In Kansas, a small exporter receives an order from Germany. The order is prepaid in dollars, but the payment is stuck in the correspondent banking system. The exporter can't ship without confirmed payment. The German buyer can't get confirmation. The order is canceled. Neither party is at fault. The system just isn't working. These aren't isolated incidents. They're happening in overlapping waves across every sector that touches international finance, which is nearly every sector. The Federal Reserve makes an announcement Thursday morning. A temporary workaround has been implemented. Dollar pricing will resume using a backup settlement mechanism. Markets will reopen for Treasury bonds at 1 p.m. Eastern. There's relief, but it's cautious. The workaround is described as temporary. Temporary means fragile. At 1 p.m., Treasury markets reopen. Prices immediately gap down. The 10-year Treasury yield jumps from 4.2% to 5.1% in 4 minutes. A jump in yield means a drop in price. Institutions that hold trillions in Treasury bonds just watch their portfolios lose value. Some of that loss is real. Some is just the market correcting for 3 days of uncertainty. But in a leveraged system, the difference doesn't matter. Losses trigger margin calls. Margin calls trigger more selling. By 3 p.m., the yield is at 5.4%. The Federal Reserve intervenes, announcing unlimited bond purchases to stabilize the market. The yield stops rising. It doesn't fall back. But this wasn't over. Currency markets reopened Thursday evening in Asia. The dollar is trading again, but it's trading differently. The euro-dollar exchange rate, which was 1.09 on Monday, opens at 1.14 on Thursday. The dollar has lost 5% of its value in 3 days. That might not sound large, but for the world's reserve currency, it's seismic. A weaker dollar means higher import prices for American consumers. It means foreign holders of dollar debt just saw their obligations increase in their local currency terms. It means the assumptions that underpin global trade have shifted. In practice, this shows up in quiet ways. A grocery chain in Ohio gets a notification from its distributor. Prices on imported goods will increase 8% starting next week. The chain hasn't announced this to customers yet. They're waiting to see if it's temporary. Day 5, Friday, payroll day for millions. Most domestic payrolls process normally. International payrolls are still disrupted. The tech company in California still hasn't paid its India team. Employees there are now 4 days past due. Some have bills due. Some have rent due. The company issues another memo. Payments are expected to process by Monday. The memo doesn't mention that expected is based on a workaround that hasn't been tested at scale. In the Philippines, a call center that handles customer service for a U.S. insurance company faces a similar situation. The parent company's payment is stuck. The call center has enough cash reserves to cover one more payroll cycle. After that, decisions will have to be made. Management hasn't told the employees yet. The employees are starting to hear rumors. Over the weekend, central banks coordinate. The term coordinate is important. They're not panicking. They're executing contingency plans that were designed for exactly this kind of event, though no one expected the event to last this long. The Bank of England, the European Central Bank, the Bank of Japan, and the Swiss National Bank all agree to expand dollar swap lines with the Federal Reserve. This means the Fed will provide dollars to foreign central banks, who will then lend those dollars to their domestic banks. It's a way to bypass the frozen correspondent banking system. The announcement is made Sunday evening. Markets in Asia open Monday with cautious optimism. The dollar stabilizes. Treasury yields tick down slightly. The sense is that the worst is over. But something had changed in those 5 days. Trust is a strange thing in financial systems. It's invisible until it's gone, and once it's gone, it doesn't return immediately just because the technical problem is fixed. On Monday, a pension fund in Canada reallocates 5% of its portfolio out of U.S. Treasury bonds and into a mix of Canadian government bonds and gold. The decision is described internally as a diversification measure. It's really a trust measure. The fund's managers watched the system freeze. They watched their collateral become unvalued. They watched redemptions get suspended. They don't want to be in that position again. Across the world, similar decisions are being made in quiet rooms by cautious people. Day 7, the following Monday. Markets are functioning, but they're different. Bid-ask spreads, the gap between buying and selling prices, are wider. Liquidity, the ease of trading large amounts, is thinner. Volatility, the size of price movements, is higher. These are technical terms for a simple reality. The system is more fragile than it was 2 weeks ago. A corporate treasurer in Germany who used to hedge currency exposure once a week is now hedging twice a day. The cost of hedging has increased. That cost gets passed somewhere, usually to customers. A shipping company that used to quote prices 30 days in advance is now quoting 7 days in advance. Uncertainty has a price, and that price is rising. In Washington, hearings are scheduled. Lawmakers want explanations. The technical details are complicated, but the political question is simple. How did the most important financial infrastructure in the world break for nearly a week? The answers, when they come, will be detailed and unsatisfying. System complexity, legacy architecture, deferred maintenance, lack of redundancy, all true, all insufficient. Because the real question isn't how it broke. The real question is what happens the next time, and whether next time the workaround will work. By day 10, most systems are operating normally. Payrolls have processed. Payments have cleared. Markets have stabilized at new levels. The dollar is weaker than it was. Treasury yields are higher. Credit spreads are wider. These are the technical residues of the event. But there are other residues. A family in Michigan whose money market fund was frozen for 6 days moves half their savings into FDIC-insured bank accounts. They lose some yield. They gain some sleep. A supply chain manager in Texas who watched his payments freeze adds 2 weeks of inventory buffer to his system. It costs more to hold that inventory. It costs more to be caught unprepared. These decisions are rational. They're also, in aggregate, a drag on efficiency. The system is slower now, more cautious, more expensive. Day 14. 2 weeks after the screen first flickered and showed 73.2. Everything looks normal. Prices update, markets trade, payments clear. But people who were inside the system during those days remember the feeling, the uncertainty, the silence, the absence of the thing they'd always assumed would be there. In a conference room in Atlanta, a risk manager updates his models. He adds a new scenario. Dollar infrastructure failure lasting 1 week. The probability he assigns is low, but it's not zero anymore. It can't be zero. He saw it happen. The simulation ends here, but the question doesn't. Systems are fragile in ways that only become visible when they break. And the dollar system is the most important system most people never think about until the moment it stops working. Those 14 days showed what happens when the invisible becomes impossible to ignore. The technical problems were fixed, the workarounds held. But something quieter shifted underneath. A recognition that the mechanisms we build our lives around are more delicate than they appear, and that delicate things, once broken, are never quite the same again, even after they're repaired. If a moment like this ever reached where you live, what would it mean for you?